Joining us is Emily Roland, John Hancock Investment Management, co-chief investment strategist. Emily, what's going on? How are you? What's caught your interest lately? We've pointed out insurance companies have a whole different sort of a view of the world at times, because the money has to be there, doesn't it, for a lot of people?
That's true, Joe. And, today we're obviously focused on the Fed. Thank you for having me on Fed Day. And I think, pointing out some of the housing data is actually really critical to the Fed's decision. There's this sort of myopic focus on the political backdrop and the potential inflationary impact of tariffs. But there's something going on underneath the surface that markets aren't really sniffing out. And that's that we're in a period of significant disinflation. You look at the housing dynamics on the supply side, we have the most inventory since 2020. Demand is starting to slow. The NAHB survey yesterday was the weakest since 2022. Home prices fell last month for the first time since January of 2023. So we think that housing disinflation will feed into the data, and it indicates that the Fed here, because they're in wait and see mode around tariffs and they might not want to acquiesce to cutting rates here, they might actually end up behind the curve. And we might see more rate cuts than investors anticipate as we close out 2025.
In a Murphy's Law world, that makes total sense, Emily, that tariffs are front and center. We're all convinced that if it's not today, tomorrow, or next day, it's going to be next week or the month after that. And we've seen number after number, PPI, CPI, core, all these things come in. And every time we say, okay, it's only a matter of time, you're saying that there are other factors contributing to that. Would it contribute enough to where we never see it, Emily, or will it eventually? Does it offset tariffs completely?
It certainly might, Joe. And one thing that we need to think about is this is a service-based economy. It is not a goods-based economy. So we think that disinflation that's playing out might be enough to overcome the potential inflationary impacts of tariffs here. We're also seeing growth decelerating. We're watching initial claims really closely here as there's more cracks in the labor market that are forming, 247, 248. We'll see what happens at 8:30 this morning. We're not overly alarmed yet, but if we got closer to the 260 mark on initial claims, that would be a signal that growth is decelerating potentially more meaningfully than markets are sniffing out right now. So with bond yields elevated still, we would look at this as a gift to lock in the elevated income that's available to investors today.
The reason I said Murphy's Law, I guess, so you've got these brainiacs on the Fed, all the PhDs and Jay Powell, and, they've all got, just resumes, and they're so smart, and they hash things out, and they have two-day meetings, and they talk. And then you got President Trump, a real estate guy. You should be lowering, when does he say not to lower rates? And last time he ended up being right about it, too. So being a real estate guy who thinks why not have lower rates, he could end up, by saying they're late, he could end up being right again, which would be, like I said, kind of a Murphy's Law thing. Is that possible, that they're too late now?
Absolutely,
behind the
Joe.
curve?
I mean,
and
yes,
you sound like you believe it. You sound like you're actually saying that.
I do think that the Fed is likely behind the curve for all the reasons that we talked about. And look, the Fed is ignoring the disinflation data the same way that markets are. The bond market is still pricing in only 1 to 2 cuts this year. To us, that doesn't make a ton of sense given these dynamics that are playing out today. So I think it's going to be really interesting. Powell has a bit of a history of sort of ending these press conferences on a dovish note. We're just going to need to see how markets react to that. Potentially, we'll start to see the dollar actually listening to the Fed as we have this meeting play out this afternoon.
Emily, how serious are your concerns about growth on the flip side, the other part of the Fed mandate? How bad is it getting, or is it going to get? We've seen some consumer numbers that are a little shaky. Is that going to be a concern to you?
Yeah, we don't think...
You like bonds, so you like it.
Yeah, I mean, we don't see recession on the horizon, Joe, but we do see growth slowly decelerating. You can see it in the data. Things like, in addition to the labor market showing some cracks, again, not terrible, that is showing that the consumer is starting to push back a little bit here. We look at manufacturing and services, and we're seeing things like PMI data, which is really timely survey data, suggests that the economy is slowing. Leading economic indicators just rolled back over as some of those key measures. You look at things like the labor market data on the non-farm payrolls report, markets seemed to love it last month, but in our view, it wasn't that great. It was lower quality. We saw significant revisions to prior months. The job gains are very narrow. So to us, that was a very low quality report. And again, markets really are so myopically focused on these stories around what potentially could happen. We're always looking at the math. We're always looking at the numbers. And we think there's an opportunity here to benefit from income, whether it's in high quality bonds or in dividend paying stocks. We think that's really the playbook for the remainder of 2025.